Investors are always on the hunt for new ways to boost returns. The market offers many different paths to achieve this goal. One increasingly popular strategy is called portable alpha. This strategy is all about finding hidden value. It focuses on separating and maximizing two key drivers of investment performance, alpha and beta. Alpha represents the skill of the investor. It is the return achieved above and beyond the market benchmark. Beta, on the other hand, reflects the market's overall movement. It's about riding the market wave. Portable alpha seeks to harness both elements. It allows investors to pursue alpha in specific asset classes. At the same time, it maintains desired market exposure through beta. Think of it as a two-pronged approach to maximize your investment potential. This strategy is not about simply beating the market. It's about doing so with greater control and flexibility. It's about creating a portfolio that can adapt and thrive in various market conditions. Stay tuned to learn more about how this powerful strategy works and who can benefit from it. Let's break down the key components of portable alpha. First, we have active alpha. This is the heart of the strategy. It involves actively managing investments to generate returns that are independent of the market's overall performance. Hedge funds are a prime example. They use sophisticated strategies to identify and capitalize on market inefficiencies. Tactical asset allocation is another approach. This involves strategically shifting investments between asset classes based on market outlook. Next, we have beta exposure. This refers to your portfolio's overall exposure to market movements. You can achieve this through investments like index funds, futures contracts, or exchange-traded funds, also known as ETFs. These investments aim to replicate the performance of a specific market index. The final piece of the puzzle is leverage. This is where things get interesting. Leverage allows you to amplify your returns by using borrowed funds. It's like using a lever to lift a heavier object. In the context of portable alpha, leverage can be used to increase exposure to either alpha or beta, depending on the investor's goals and risk tolerance. However, leverage is a double-edged sword. While it can magnify gains, it can also amplify losses. Therefore, it's crucial to use leverage responsibly and understand the risks involved. Portable alpha offers several compelling benefits for investors. One significant advantage is diversification. By separating alpha and beta, investors can diversify their sources of return. This reduces reliance on any single strategy or market factor. Another key advantage is flexibility. Investors can target specific sectors, regions, or styles without market exposure restrictions. Efficiency is also a major draw. Portable alpha allows access to alpha strategies without allocating the entire portfolio. However, potential downsides exist. Leverage risk can amplify losses. If an alpha strategy underperforms, leveraged losses can erode portfolio value. Alpha risk is another concern. Active strategies may not outperform the market. Finally, derivative risk is a factor, especially with beta management. Derivatives have unique risks like liquidity and counterparty risk. Let's look at a real-world example. Imagine an investor wants exposure to the US stock market but believes they can generate additional returns through a specific hedge fund strategy. This investor could allocate a portion of their capital to the hedge fund, seeking to capture alpha. Simultaneously, they could invest in a low-cost S&P 500 index fund, or use futures contracts to maintain their desired beta exposure. So, who typically uses portable alpha? This strategy is popular among institutional investors like pension funds and endowments. They manage large sums and have a long-term horizon, making them well-suited for portable alpha. Hedge funds also use this strategy to optimize their risk-return profile. High-net-worth individuals utilize portable alpha to enhance returns and diversification. However, it's essential to remember that portable alpha is not a one-size-fits-all solution. It requires careful planning, ongoing monitoring, and understanding of the risks involved. Consult with a qualified financial advisor to determine if portable alpha aligns with your goals and risk tolerance.